Okay, so some of the tax benefits of owning rental properties. So that's one of my motivations for obtaining rental properties was first for generational wealth for my children, but also for the tax benefits. So let's talk about some of the things that you can write off that will benefit you on the tax side on a rental property.
Yeah, one of the biggest benefits of owning a rental property is the depreciation deduction. So a residential rental property is depreciated over 27 and a half years. So you take the cost of the property, any improvements you've made to the property, less the land piece of it because land is non-depreciable. Then you divide that amount by 27 and a half years and you're getting a deduction for that on your return every year, even though that wasn't the actual cash outlay. So depreciation is one of the biggest benefits of a rental property because you can have positive cash flow, but actually show a rental loss. So that's another important thing about rental properties is they generate passive income. And so passive income can only be offset by passive losses. The advantage to passive income is that it's not subject to self-employment tax that you would have on business income. So definitely advantages to it. However, there are limitations because passive losses can only offset passive income. There are some exceptions to that based on total income on the return. If you're a real estate professional, things like that. Just basic general conversation, passive losses can only offset passive income. Something to keep in mind, you guys are able to add back depreciation, right? Yeah. On a rental property. So it'll show as positive income, more positive than was actually reported on the tax return. So just another even added benefit for owning rental property is that you're not penalized from a loan approval process with that rental loss that you're getting a tax benefit.
Yeah, so you can still have that rental income coming in and then you can write off like their line items. And again, the write-offs and how it impacts you depends on your income, but you can write off taxes, insurance, but there's line items for it. Again, the write-off depends on you. And then interest and then depreciation. And from a lending perspective, we can add those back in because depreciation can be added back and you're paying the insurance, the taxes and all that on your credit already. So we get to add that back in. So even if you have a loss on your Schedule E for the rental property, with those add backs, it could break even. So now you're getting the tax benefit, but you're not getting penalized on the lending qualification side. So one thing you said that I really liked too was if you are a real estate professional, because Nicole works with a lot of real estate professionals, and if you are a real estate professional, there are additional tax benefits to owning residential real estate as rental properties because you get an additional write-off too, right?
Yeah, so there are definitely important things that you need to do and follow to qualify as a real estate professional. So as an example, you can't be a CPA like me, have a full-time job working as a CPA, and likely qualify to be a real estate professional. So it's intended for people that are in the real property trades or businesses, and there are different metrics that allow you to qualify for that. If you do qualify for the real estate professional election, you can actually use those rental property losses to offset active ordinary income. So then you could use a $25,000 real estate loss to offset $25,000 of ordinary income. So it's definitely an added benefit for real estate professionals. But there's also been a lot of abuse with it. So it's definitely something that you really want to substantiate how you have met the qualifications and the tests for it.
Perfect. Yeah, I think you have to work like 750 hours in the real estate side, but it's just another advantage of how residential real estate is a great investment, not just from an appreciation standpoint, but from the tax benefit as well.
Yeah, and also as you talked about with generational wealth, depending on how you have it structured, there are various ways to do this from an estate planning perspective. But when you pass away and those properties are inherited by your kids, they will actually get a step up in basis. So if you bought the house for $300,000, when you pass away, the house is worth $500,000. Their basis is $500,000. So if they sell it that day, they actually have no taxable gain because they got that step up in basis. So another just good tool for passing down wealth, because they get that step up in basis automatically.
That's important to know because that, again, for my situation, I purchased homes for each of my children for when they graduate high school, whatever they decide to do, they have a property that, in 10 years is going to be worth 5-10 times more. Average depreciation in Colorado Springs is 12% right now. So do that math. So that was kind of my thing. But if I give my daughter who just turned 18 this house right now that's doubled in value, she's going to be stuck with those capital gains. If I wait and protect that in like a trust or something, and then I still let her kind of run that property as her own, but I pass it down to her through my death, basically, then she avoids those capital gains.
Yes.
Yeah, so that's another really good strategy. Okay, so the next thing, a hot topic right now, or kind of a common thing, is Airbnbs. Which I would love to dive deep into these on painting the Airbnb aspect, because it's something that I kind of fail to realize the cost of going into Airbnb ownership, just the cost to set them up, furnishing, all those things. So, but they can be tax deductible, but Airbnb is looked at differently on a tax basis than a regular rental property. So tell us a little bit more about that.
It can be. So usually, by definition, rentals are per se passive per the IRS. So a rental property is passive unless something makes it otherwise. Okay. Airbnbs or short-term rentals can be considered rising to the level of a trade or business, subjecting them to self-employment tax if different things are met. So if it operates more like a hotel, so average rental period is less than 7 days, if there's substantial involvement in the property, so if it's more like a true bed and breakfast, you're cleaning the place every day, making the bed, giving them new towels, potentially providing food, those substantial services can actually mean that an Airbnb is more of a Schedule C business rather than a Schedule E rental property. So that's something to keep in mind. It's multi-factored, and it's something that's evolving as Airbnbs are becoming obviously much more popular, but definitely something that the hotel industry is really like kind of pushing towards because they're taxed as businesses. They're not taxed as short-term rentals. So it's an evolving thing for sure. And especially, as they become more common, we'll get more guidance as things progress. But something that a lot of people don't realize is that if you are very actively involved in those properties, in providing substantial services for them, and the average rental period is less than 7 days, it can actually be subject to self-employment tax rather than not.
Yeah, and I've heard some areas too, they will actually increase the property tax because then they will consider it a commercial property, even if it's zoned residential, because if you're running it as a business. So that's where it gets tricky, where short-term can be beneficial, month to month on the income piece, but you just want to be careful that you're protecting yourself on the tax piece as well.
And then how does it work from a lending perspective though? Are you guys able to look at Airbnb income the same as a long-term lease? Is there a certain lease length that changes the approval process?
So that's a great question. So when you go to purchase a property and you're wanting to use it as short term, there's not a way to really have a metric for what that property is going to bring in an income. So generally, we will look at what it would work for long term. So like, let's say it rents long term for only $2,000 a month, but you're like, well, I know as an Airbnb, I can get $5,000. We can only count $2,000 for you to qualify. Unless we do a non-traditional loan, then, there's more things that we can do. We can look at the history of that Airbnb income. We might be able to consider that, but generally, we're looking at worst case scenario. So what is the minimum this place would rent for if you had to run it long term? Because Airbnb is not always successful. Now, if it is an Airbnb that you've had and you've reported to your Schedule E for 2 years, then we would average those 2 years like we would do any other residential Schedule E. So whether it's Airbnb short term or it is a regular long term rental, we would factor that the same with the 2-year returns. But going into purchasing it, we do have to take the lesser of the two on qualifications.